Well, it was a huge week for financial markets last week as Donald Trump and a red wave swept into Washington, D.C. after the election, sending the S&P 500 to its best week in a year and the dollar to a sixth week of gains as well, while the Fed and the BoE both delivered 25 basis point rate cuts. This week feels a little bit like the calm after the storm, with the economic calendar looking considerably quieter, although we do have the latest US CPI and retail sales data highlighting the docket for the week ahead. Plenty for myself and Ryan Littlestone to discuss on the trade-off. Without further ado, let's crack on with the show. So it was a busy week for markets last week, and in fact, it's been a busy fortnight for markets because it was a very hectic week the week before that as well. Joining me as always to try and make sense of what's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, have you recovered from the chaos of the last couple of weeks?
Just about. I did have a few beers on the weekend to get over it, but you say they're calm after the storm. It doesn't look very calm at the moment looking at markets, and it's supposed to be the half-day US holiday as well. So, yeah, we're straight back into it seems.
Yes, no rest for the wicked, as they say. Well, we've got plenty to crack on with this week, so let's get into Topical Thunder. Yes, like I said, plenty to get our teeth into this week, and where better to start than with the election from the United States. Unless you've been living under a rock, I think you'll probably be aware at this point that Donald Trump is on his way back to the White House for a second term, becoming just the second man to serve two non-consecutive presidential terms, of course, after Grover Cleveland. And actually, far from the election being the horrifically drawn out and prolonged, protracted affair that we had expected, it was all done and dusted by breakfast time here in the UK. And actually, the result was very, very clear before that. And I guess in short, it's a case of the GOP really having crushed and beaten the Democrats convincingly, no matter where you look. In terms of the presidency, Donald Trump, of course, having won the presidency, won the Electoral College by a significant margin, 312 votes to 226, carrying all 7 of those pivotal swing states, and importantly, even winning the popular vote, which he didn't manage to do when he first won the presidency back in 2016. On top of that, the Republicans on course to flip control of the Senate. They're on track to gain at least 4 seats there. And in terms of the House, they are set to retain control of the House of Representatives. There's about 20 or so seats still left to declare, and the Republicans need just a handful of those in order to retain control of the lower house of Congress. So all 3 levers of power in the GOP's control. What does that mean? Well, I think there's a few sort of implications that we can draw from that. And of course, Ryan, I'm keen to get your views as well. Firstly, I would say that really there is going to be no limit at all on Trump's plans and his agenda. Not only do the GOP control Congress, but it's really Trump's, or to Trump's credit, that a lot of those lawmakers have been elected. They are all very, very sympathetic to Trump's point of view. I think also you're likely to see a possible front loading of some of the plans. We've got the midterm elections in 2026. They are just 2 years away. So you could actually see the GOP go, well, actually, let's act sooner rather than later on a lot of these ideas in order to ensure that they can sort of strike while the iron's hot and get things through while they have full control over Congress. In terms of market pertinent matters, at least, I think the fiscal stance is going to be a relatively loose one. We're obviously going to get an extension to Trump's previous round of tax cuts. The question now is, do we get any more? And there'll certainly be a significant rise in government spending as well. And then in terms of trade, I think things are going to be relatively hawkish. We already see that Robert Lighthizer is back as US trade representative. He took a pretty tough line on China in the first Trump administration. And I don't think there's any sign of him doing things differently this time around.
No, absolutely. And we're in that period, I should describe it. I don't know how to describe it. We're in that period where he's not quite in the hot seat. He's building his cabinet around him. Names are getting dropped in, and the market's reacting to those as well. First and foremost, the election itself, as you said, pretty much a clean sweep, which is good on one aspect. It means we're not going to face weeks of uncertainty and messing around who's going to win, who, vote counts and all that sort of stuff. So that's one thing that the market can take from it. But the rest, we're in that just grace period, if you like, before he takes a seat in January, where we're going to find out what his policies are going to be. What's he really going to push for? We've heard all the campaigning pledges and promises and whatnot, but it's actually what he's going to push for in reality moving forward.
Yes, indeed. That's absolutely spot on. And I know you want to dig into the market reaction to the election a little bit more.
Yeah, so we sort of continue this vein of topic around the elections. And really the latter part of last week was about what the market did. Initial result reaction was to buy dollars, sell bonds. Commodities got sold either on the back of the dollar reaction or the potential tariff threat to the likes of China and elsewhere. Currencies like dollar MEX, that it rocketed up to 2080, then it came all the way back to 1970, then it's moved back up to 2020 last week, and it's going off again today. Dollar China had similar moves. So all these assets that were going to be or likely to be impacted by Trump's policies really reacting here. They did that on Wednesday. So we had the reaction on Wednesday, a reversal on Thursday, roughly half of some of those moves. Then it reversed again on Friday. So Thursday and Friday really...
Busy with all these bloody reversals going on, aren't we?
Trying to trade it is an absolute nightmare. I can't say I made any money last week. I can tell you trying to trade through it. But, Thursday and Friday, it really felt like the market didn't really know what to do after the initial reaction. So the important factor now is what happens going forward. I think we might be able to rely on the chart levels a bit more now. But I think we're going to see a lot of new trends and correlations forming as the market gets to grips with Trump and what's to come from his policies. This is a moment where how things moved pre-election may move differently post-election. So if you've been trading a certain way, certain strategies, and that's been working, and you start to get signs of that breaking down, you need to sort of pause, reassess your strategies to confirm whether those are breaking down or not. Conversely to that, we've also had confirmation that Trump could be active on the social media formats again. On Friday, there was a story out that he was going to be getting out of his Truth Social business. That did the rounds, hit the stock price. Then he came out with a denial on his Truth Social platform. It hit there before it hit anywhere else. The markets picked it up, or the main wires picked it up afterwards, and his stock rallied some 12% in minutes. And we had this in his first term. So to have it again is potentially a real moneymaker for us mere mortals if we can get that news at the same time or even just before the main wires.
Oh, blimey, that's a dangerous road to go down. I certainly would not, never offer any advice, but certainly would advise against, trading on the back of Trump tweets. I mean, I'm not sure he knows what's going to come out of his mobile phone next, let alone trying to guess the market reaction from what he sends.
Yeah, but you've got to take, he's posted a ton of stuff over the weekend that doesn't mean anything at all. But he did this in his first term. He posted certain things where the market was saying, if he does X, Y is going to happen. And he posted saying, no, I'm doing Y, so Z happened. So we did have that. And if he gets back to that, if you're a news trader like I am, and even if you're not, you are going to potentially get, the news the same time as everyone else. This isn't going to be released to Bloomberg or Reuters ahead of everyone else, and you see it after the market's moved. You potentially got an edge here if it's the right type of market move, and you've got to know how to read it and understand it, of course. But obviously that's something we look at in detail.
Indeed. And I'm sure we're going to be talking about plenty of Trump tweets or X's or what is it? Truth platform, Truth Socials, whatever it is. Well, someone needs to go and brush up on that, I think, before we start talking.
You need to go and get an account, I think.
Well, apparently so. I think that's apparently where the future is. Anyway, moving on to more conventional matters, because, of course, we did have a Fed meeting last week. I know it went slightly under the radar. Let's be honest, it was pretty much exactly as we had expected, with the FOMC delivering a 25 basis point cut, taking the target range for the Fed funds rate to 4.5 to 4.75%, and pretty much delivering a carbon copy of the policy statement from September, with no real significant changes, and continuing to note that risks to their dual mandate are still roughly in balance, and that they will take a data-dependent and meeting-by-meeting approach. I've got to be honest that Powell's press conference was probably one of the most boring that he's held during his 6-year tenure now as Fed chair. But really the key message was that they are going back to neutral, and the speed of the journey back to neutral will hinge on the data that comes in. So my base case in terms of the FOMC is that they will deliver another 25 basis point cut in September, and that they will probably then deliver cuts of that magnitude at every meeting until they get back to neutral next summer. Although what I would argue is that actually the risks around that base case have become significantly more two-sided since Trump was elected. Now, previously we were saying that's the base case. If the labour market weakens significantly, unemployment rises north of 4.4%, then they're going to throw the idea of a 50 bip cut back on the table. I think that's still the case. But there is now a hawkish risk that is being introduced, or at least is likely to be introduced in early 2025, because you look at what Trump wants to do, and you've got reflationary fiscal policy with tax cuts and fiscal stimulus likely to give a bit of a fillip to economic growth. And then you've also got inflation risks as well around the tariffs that are proposed to be introduced. So I think that while the Fed are still on autopilot for now, and I think they probably will be until, let's say, the end of January, I think Q1 2025 could be when Powell and co really need to earn their money a little bit more.
Yeah, for me, it was I say a bit more interest in the meeting. It did go pretty much exactly as expected, with a cut and trying to avoid all the political potholes that journalists threw at him. But then there was that omittance of the line in the statement that they are, gaining greater confidence in inflation. As soon as I read that, I booked dollar yen on the back of it, and a load of people in our chat room did too, because it looked on the face of it like a bit of a hawkish tilt, saying that they hadn't got greater confidence in inflation anymore, and thus the removal of that line. So that looked really hawkish. We sat through the presser. Dollar went up, dollar went down a bit. And then the reporter asked him specifically on that, what does that mean, removing that line? And he went, nothing. I couldn't hit the sell button fast enough to get out of that trade. And that was key. He said he didn't want to give too much forward guidance or some other blathering like that. So it looked like it was going to be interesting, then it wasn't. But yeah, what's changed now is that the market, after the Fed and since Trump's got in, a lot of banks are now bringing down their forecasts for Fed cuts, really reducing them. I think TD was the latest one. They don't see any more cuts coming this year. They don't see any cuts coming in the first half of next year. So a lot of banks are bringing that down. Obviously, December is the last forecast meeting of the year. So that will set up what's going to happen in 2025. But it seems the market might be getting a little bit too hawkish. Or undovish.
There we go.
Here it is. I had to get it in sometime. It seems the market is maybe going a bit too far the other way. And we remember what happened at the beginning of this year with those forecasts.
Yeah, do you know what? I think there's a little bit of a misunderstanding going on in terms of the sell side generally around how the Fed operate, and actually how any central bank operates, because the BoE are having to deal with this as well, in that they can only react to and make policy based upon and make forecasts based upon the currently enacted fiscal measures as they are at the time of the meeting. So it's all well and good, everyone on the sell side going, oh, well, Trump could do X, Y, Z when he comes into office, which means the Fed shouldn't cut again this year. The problem is FOMC policymakers are going to be sat around an incredibly large table saying, great, well, this might be on the horizon, but we don't know that yet. And how much would those same people slag the Fed off if they made policy based on something that might or might not happen? And then if it didn't happen, well, the Fed have then got a huge amount of egg on their faces. So I do have some sympathy for Powell and co here, because they're having to follow this sort of trajectory that they've outlined. Of course, remember, that according to the dots, they've still got another 25 basis point cut in them. The forecast they unveil in December are almost guaranteed to be out of date within a month or 6 weeks, because we're going to have a new president in the United States. But they've got no choice. They can't make policy based on if, buts, and maybes. They have to make policy based on the reality of the situation at the moment. So, I think everyone's getting a little bit carried away with the sort of hawkish side of things, but gives an opportunity to fade some of that repricing if we see it.
Exactly. And, we had it on the show earlier this year, when the market was getting very dovish, the Fed, and then it got very hawkish, the Fed. And, we were talking about yields, they were trading 2-year yields, trading around the 4% mark. I said, that's looking a little bit rich. I wouldn't be surprised if they're down at 370, maybe even worse. They got down to 350 before rallying. So this thing's great. The banks and their forecast, as much as I slag them off, it's great for trading, because it does give you those extremist moves in the market that you can potentially fade at most points.
Indeed, spot on. Well, it is, I guess, a quieter economic calendar this week, but there's a few bits and bobs on there worth singling out nonetheless, aren't there?
Yeah, well, now we're done with all the major central banks pretty much for November. It's all coming down to the final meetings of 2024 in December. So that means every data point from now on in is going to feed into expectations for those meetings. This week we do have some key data coming, and obviously the usual flood of central bank speakers. So starting with those speakers on Tuesday, that begins with one of the Fed bigwigs, Waller. He's speaking, then he's followed by Barkin and Kashkari, then Harker. Wednesday, we get one of the big hawks, Mann, who obviously voted for rates staying on hold last week. She speaks as well, so we might get some insight as to why she was the lone vote for keeping those rates unchanged. Then on Thursday, we get Fed and BoE governors Powell and Bailey speaking. I know Mark will be looking forward to Mr. Bailey speaking.
I cannot wait.
Sorry,
can I just say on Andrew Bailey, I know it's very rude of me to interrupt, but we said Powell's press conference was a bit boring. I mean, God, Andrew Bailey's last week, talk about dull. Jesus.
Yeah,
well, I think he did give a bit of a better explanation on what's been going on with gilts than you have, mate. So I might get him on the show.
Yeah, you said that, didn't you? His trading strategies that came to the fore about who got stopped out. That probably highlighted the whole thing. And as I said, he's probably got better chart skills than you have. So you might want to move on quickly from that one.
It's a low bar, mate. It's a low bar.
I'd say, like you said, it's a very low bar for that one. Anyway, carrying on. On the data front, we'll be seeing a lot of final CPI numbers from Europe, as well as some Q3 GDP revisions. But the big data really is the US CPI data on Wednesday. That one's really going to set the tone for the December FOMC, at least in the early stage, because we will have another CPI report before then. We're expecting both headline and core to come in unchanged at 2.4% and 3.3% respectively, though this morning I have seen a few calendars showing that they expect CPI maybe to tick up to 2.5, 2.6%.
Bloomy have got it at 2.6, I think.
2.6, yeah. When I looked yesterday, they had it at 2.4, so they probably woke a few people up Monday morning.
That's all because of energy anyway, so it's not a huge deal.
No, it's not. But if it does go up, that's going to push a lot of people maybe towards a more hawkish side of the Fed. So on Thursday, we've got Aussie jobs, which could be a key for the RBA because their labour market's been pretty tight over there recently. So if there's any weakness there, that might get a few doves coming out of the tree. US PPI later on, that will be a bit of a follow-up to the CPI data. Friday, we get a good flood of Chinese data, and we just had CPI out from them looking pretty weak still over there. And then to cap us off, we got US retail sales. That one, I think, will be watched pretty closely just to see if spending has maybe slowed ahead of the election. And then as we enter the big holiday period, Christmas, the Thanksgiving, the sales events that are going on. So that could be a key number to watch on Friday. But other than that, I will be oiling my interest rate pendulum as usual for all the data and swings in rate expectations that's going to come from that data, no doubt.
I was sort of slightly concerned about where you were going with that. I'm glad that's where it ended up. I know you loathe the 7 a.m. starts, but you've even missed a couple of UK releases this week. We've got the latest jobs data out on Tuesday. Of course, that'll be out by the time you watch this, and also GDP on Friday as well. And I think downside risks to that GDP print are pretty chunky, given the hit to consumer and business confidence that we saw in the run-up to Chancellor Reeve's budget in October. So I think the Q3 GDP number is going to be relatively anemic, and of course we'll see whether that elicits any sort of response from the BoE. But certainly for me, I think the retail sales print out of the US that you mentioned is probably the main event this week. The Fed are pretty much saying that the job is done on inflation at this point. So it's really a question of, are consumers still spending to sustain the expansion?
Yeah, well, I'm not sure that the job is done in inflation, particularly if it stays unchanged again. And that is the risk. For me, that's the bigger number than the retail sales. But we'll agree to disagree on this one.
We will indeed. Right, let's move on to some charts. Right, I'm going to kick things off with a chart that's already out of date. So you're going to have to look at it anyway, I'm afraid, because I put this together on earlier this morning, and gold is now another 2% lower. So just imagine that candle is a very, very big blue one that's fallen to the downside and broken below the 50-day moving average. As we record, the yellow metal trading at $26.35 an ounce, about $50 below where we are on this chart. But it does seem as if gold has started to lose some of its shine in this post-election period. The highs around 27.90 look to be a bit of a top, at least in the near term at least. And now, of course, we've having broken below the 50-day moving average as well. I think that's going to entice further bears to the table, with $2,600 an ounce the next target to look out for in terms of support to the downside. I think there's a few things to bear in mind here. The first is you look at the post-election reaction. The dollar has just been bounding higher. Yields have been moving higher as treasuries sell off, particularly at the front end of the curve. And also you've got momentum. Momentum works on the way down as well as on the way up. And I think a lot of recent entries to gold on the long side are finding that out relatively quickly as the new trading week gets underway.
Yeah, I think this week we might need to move to doing live analysis on these shows rather than doing charts yesterday and this morning, because I seem to go out of date pretty quickly right now. Yeah, there's a lot of people, some people saying, oh, this is it. This is the end of the gold rally. It's all downhill from here. For me, just looking at your chart, taking a longer term view, it's still in pullback territory, in my opinion. I think 2620s, 2600 is going to be a key level. If we get below that, that could indeed trigger some more stops and a few short-termers thrown in the towel. But yeah, I'm uncertain this one. We did have a bit of an area, that 2685, 2670. We tried holding it this morning, failed. So yeah, we've got the level that we need to look at as far as sort of a pivot level goes. But at the moment, yeah, it's looking a bit bearish, but don't think it's going to go to the floor just yet.
Well, we shall see. But I mean, at least for now, it looks like gold is not indestructible and has stopped believing in its soul.
That's it. I'm barring you from doing gold for the rest of the year. You can't look at gold for the rest of the year or any other.
It's only about 3 shows.
I don't care.
I'll find another Spandau Ballet song to riff off next week. Right, moving on to the euro.
Yeah, I'm gonna write a letter to Westy. I think it's gone far enough now, mate.
With the Royal Mail, it probably won't get to Australia until next year. Exactly. So we're all right.
I'll post it on Truth Social. There you go. Yeah, I'm going to talk about the euro. A bit like Michael, I've had to redo this chart about 20 times today. Post-election, euro dollar is now breaking a big level at 107. It already tried twice right after the election, got down to sort of 106.80s, but this third time looks to be the one. And the importance of this level is it's pretty much the gateway to an even bigger level down at 105. That is a real huge multi-year level that stretches back as far as the early 2000s. Now, we've got a few levels obviously in the way of that 105 level, but the main one is really the low 106s into the 106 figure. But first things first, we need to see this 107, whether it's going to hold and commit to this break, which it does at the moment. We're trading down to 106.50s. In the interim, we will need to retake that 107 level before any attempt at heading back up. But even post-Trump and after the first dips, we found resistance around 108.30, which is part of a big 108.30-70 zone. But irrespective of Trump, the fundamentals still favour the US over the Eurozone. So as long as that lasts, we're probably going to see euro-dollar more as a rally seller than a dip buyer until something changes in that parameter.
Yeah. Do you want to bet lunch again? Because I feel like I've got half a chance of winning.
Here we go. Now we're talking.
Well,
what's the bet?
I think the last time we were trading around these levels, I said, "Oh yeah, we'll get to 105 before 111," and then guess where we ended up. So,
well, exactly. Go on, name it. What you calling?
No, it works quite well because win or lose, you seem to pay. So actually, we could bet anything, I think, these days. But we shan't. We shall be sensible. And which the S&P 500 did have a couple of weeks of losses. And then last week, it put in its best weekly performance for 12 months after the election, with the front month future trading north of 6,000 for the first time ever. And the market having put in 50 record highs this year. And as I speak, being set for a 51st to kick off the new trading week. And that is the 7th best calendar year ever. And of course, we still have about 6 weeks of the year to run. The three legs of the bull case that I've had for most of the year remain intact. Strong economic growth, strong earnings growth, and the Fed put, although of course the risks around that latter one becoming a little bit more two-sided into 2025. But I think for now, the market is also being helped along by a couple of other things. Firstly, now that the election is out of the way, positioning is a lot cleaner. There are not people looking to sell into rips to hedge some of their exposure ahead of the political risk that we had coming up. And secondly, is that there are a lot of expectations out there that Trump coming into office is going to see some fiscal stimulus, and that is going to give a fillip to both earnings and economic growth. So I think between now and the end of the year, the path of least resistance will lead us in the same direction it has for most of 2024 so far, and that is to the upside.
Yeah, and we've been saying it pretty much every week this year. What's going to stop this? And I think you're right. I think your three legs are still firmly in place, and maybe they just need to have a little competition on how high it's going to get. I don't know. This could be 6,200 by next week. It could be 7,000 by Christmas. You just don't know. I think what we do have to look for is what may tip the stock market over eventually, because nothing can go up forever, particularly this fast. So if we do see a big sort of parabolic rally, then we'll have to look at where the pullbacks are coming in and what's going to cause them. But I don't know right now what that's going to be.
No, and without wishing to tempt fate, it doesn't seem like that is on the cards at the moment, does it?
No, absolutely. So market's always going to have a bit of two-way action, but at the moment, this one's going to be going higher, I think.
Indeed. Well, somewhere where the market is not going higher is here in the UK.
Yeah, and this is a trade I looked at prior to the budget, the UK budget, as thoughts that it was going to be perhaps more negative than positive. Pre-budget, we were sailing merrily up at all-time highs, but now things do look decidedly different. And this is the FTSE All-Share index, so it's the one that's a bit more domestically based than some of the multinationals in the 100. The index has dropped just shy of 4% off those recent highs as the budget produced those higher taxes for what looked like very little reward. Though there wasn't anything massively negative for firms outside of the employer national insurance hike. So and also the minimum wage hike as well.
Hang on a second.
He's digging in.
Is that not negative enough on its own? I mean, what else do you want them to be doing, for goodness sake? I mean, that's about the most anti-business measure that you could bring in, raising the cost of employment to that significant a degree. I mean, even some of the major companies, Sainsbury's, M&S, they're looking at 120, 150 million quid a year extra to employ people here in the UK.
Oh, well, they can just up how much you pay for a pot noodle, mate. They're to cover that.
You've set me off now.
I know. I thought I didn't know whether I need to sit back and put my feet up. We had a little rant about that one. It is negative. Hence why I'm pointing out what's happening in stocks. But it could have been a lot worse too. They could have hiked up corporation tax and put in a ton more policies to make it harder for companies, rates and business rates and things like that, which they froze. So yeah, it was bad news, obviously, but it could have been worse, I guess. So therefore, I'm not expecting a big, massive drop from here in this index, unless the UK does start trending lower with growth and whatnot. Now, there's a bit of a level down here on the chart at 4,400, 4,390. So if the price base is there, it will keep the range and maintain this range that we've had intact. If not, a break could see another test of the 38.2 fib down at 43.45, or even a move down to the 4,300 level, which has seen plenty of action going back earlier this year, March and April, and also back longer, a few years as well. So if you've been short this one off the top, we get into levels where it might be wise to take a bit of profit to protect against the bounce. But I'm not expecting an outright collapse in this market, and maybe it'll even get dragged up by the S&P moon shooting again.
We'll see about that one. But I think my view on just UK equity in general, whether it be the All-Share, the 250, the 100, whatever, it's just going to go sideways. I mean, there's nothing that sort of screams sell, but at the same time, there's nothing that makes me go, we're going to see the UK market outperform the US or Europe or, Japan or wherever over the next 12 months. I just think we're going to be in this kind of turgid, range-bound choppiness for the foreseeable future, which, for short-term traders gives plenty of opportunity. For longer-term investors, it's probably the ugliest chart you can imagine.
Yeah, I wouldn't say the ugliest. There's some uglier ones out there, but you only need to look at China as one of them. But yeah, if you're not gonna, if you haven't got something for the long term, then the best thing to do is range trade, and it's developing enough levels here that you can play down here into the lows and go short again at the highs, and you can keep the trades fairly tight. A level's a level until it's not, as we like to say.
Indeed, that is very true. Right, let's move on to our plays of the day. Right, so a couple of dollar-related plays for you this week. Firstly, kicking things off with the dollar index. Another chart, well, you need to use your imagination, I'm afraid, because we're trading at 105.5 now, rather than the 105 that you see on the chart there. But it does mean that we are very, very close to, if we haven't already, taken out the election night highs, which are also the highest level that we've seen since, it would have been the middle of July when we were last trading there. And of course, election night itself was the dollar's best one-day gain since March of 2020, when a small thing called COVID was starting to rampage across the world. I think the theme that's continuing to fuel the rally is this idea of US economic exceptionalism. And I think that theme is only going to become more significant now that Trump is in the White House and that the GOP have swept to power in both chambers of Congress. I think it's still, personally, very tough to want to be long of really anything else in the G10FX world at this moment in time. When you look at upside targets, you would say that the highs that we saw in late June, early July at 106, and then maybe even the top of the recent range around 107 would be on the radar, with the 200-day moving average to the downside at 103.85, 103.90 acting as support. But so long as we trade above that, then I would be bullish on the buck and buying any dips that may occur. Ryan, we're going to Canada.
Yeah, and I'm looking at dollar CAD for my play of the day this week, and it's in one of those trading moments where the moves here could turn into something very, very big. I've spoken about this pair plenty of times on the show, and it's always been about trading the range, and we're right at the top of that now, and I've even been sitting up here for the last couple of weeks. So I'm getting a bit of a feeling that we're heading for at very least a test of 140, if not a potential break, and one that if we do get a break, it could be quite explosive. So the key level up here is 140, and so my first thought is maybe to run some buy stops through that level, say 140, 20, 25. But I'm also looking for a potential dip down to maybe the 138 area, which I don't think is coming at the moment. I was actually watching for that over the Canadian jobs data last week to see if I could get a dip to get long, but that turned into a nothing burger. Now, this time, for dropping orders, it's not a time for just dropping orders and shutting your eyes. I will watch and gauge the price action to see if my feeling about this break remains valid or not. There's still obviously a chance that the levels up here hold and we maintain the longer range. So if we do get a 140 break, though, then there's every potential to go for a run at the massive double top in the 146s. So I'm preparing the traps, and let's see if they get sprung.
Indeed, we shall wait and see. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, if he's still awake, for bringing this show together as brilliantly as always. If you've enjoyed the show, please drop a like on the video, leave a comment as well. Let us know how you're trading the markets and if there's anything you'd like us to discuss on the show. In a fortnight's time, that is when we'll be back. I am taking the liberty of a week off next week, which I've already been ribbed for significantly, so we won't go into that again. But anyway, we will be back in 2 weeks' time with another episode of The Trade-Off. Hopefully I won't be as sick as a dog then, and we can get our teeth into what has dominated markets, and also look ahead to December, which I'm sure is going to be a pretty busy month to round out the year. In the meantime, thank you very much as always for watching, and goodbye for now.